Hi, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to what we do each and every week. We come to you on KCAA Radio. I want to say hey again to those fine people out there at San Bernardino and Riverside counties, people that have been sticking with the show for all these years. I really appreciate it. We're on Saturday and Sunday. You're driving around, doing what you do on the weekends. You can tune us in, and maybe we can help you with some of the decisions. Everybody's got to make those decisions once in a while, right? Where you have a house, you want to buy it, you're not quite sure if you can afford it, but you need a professional to talk to. So we're not going to place any kind of pressure on anybody who listens to the show, but we have experts to where I work. I work at Malibu Funding. That's the company that sponsors the show each and every week. And as I said, we bring to you some information that might be able to help you ease some of the concerns or maybe answer the questions. Certainly, as I said, there are plenty of them out there, especially if you're a first-time home buyer. You're in this particular market. You have two people working. You're making good money, and you're trying to find a house, and you can't find one, or the mortgage interest rate that you're being charged is way above what you think it should be charged, or you have any number of other questions that you have about the property itself, about the mortgage process. That's why the show exists, because we try to bring you that information in a friendly way. Sometimes we have guests on the show. A lot of times we have guests on the show. And a lot of times I just talk about what's going on in the economy and how that might affect you. Certainly what's going on overseas, what's going on in China may not seem like it affects you. But supply and demand being what it is really does take an effect or bite out of your budget, or whatever you want to say about the money you have in your pocket. The more you have there, the more you can spend on your house. We try to look at housing and the way that debt is organized, not to be above a certain amount of money per month. And that's what they call the debt-to-income ratio. And every lender who is really part of TRID, which is anybody who sells to the agencies, Ginnie Mae, Fannie Mae, Freddie Mac, these are the government-sponsored agencies, GSEs, government-sponsored entities, that buy the loans from the banks, from United Wholesale, from me, from Quicken or Rocket Mortgage, and there are many, many more out there. There's 9,000, I think, different types of lenders out there who can provide you with mortgage services. So there are all kinds of ways by which people try to help to fund those particular loans. And of course, the GSEs, the government-sponsored entities, are the main ones that everyone seems to. That's what they call the conforming loans. And those conforming loans, being what they are very helpful to the mortgage marketplace, because without having some place to go with those loans, the money would freeze up. Now, we talked earlier in the section right before this one about freezing up in the marketplace when it comes to real estate, and why there's such high demand, but there's no product on the market. And it's because there's this frozen effect when rates come into effect, when they're so low that nobody wants to now get out of that low interest rate environment and low interest rate that they have on their house, to sell their house, to move on to a different house, because you're never going to get that rate again. You're going to get 7.5% rates where they are now. So we'll talk some about that, and we'll get right to the rates. Anyway, if you are listening to me, you can go to Jeff Barton, the Mortgage Voice on YouTube. You can see me, let's see, on our website, themortgagevoice.com, which is a good place to go to find not only the guests on the show each week, but my voice, my face, way to contact me, way to contact the guests. All these are terrific ways by which you can stay involved with the process of trying to learn more about what's going on in the mortgage market, what's going on in the real estate market, and how these things that happen outside of your control really affect you, because they affect the rates and the availability of funds that the lenders are going to be able to lend to you. So let's get right to it. 30-year fixed rate loan, 7.22%. 6.58 is the 15-year. 6.72 is the FHA. 7.32 is the jumbo loan, and 6.58 is the 5/1 ARM. Have you seen the way the rates for the 5/1 ARM and the 30 and the jumbo have really developed a spread here? We almost are 0.75 of a point spread, whereas before they were almost neck and neck. We've talked about it in the past, but I'll reiterate it again. Jumbo, nobody wants to do them right now. Why? Because the jumbos that were done at 3%, 4%, 5% can't be sold. Nobody wants to buy those because the yield that you're getting on either the bonds you're selling or on the straight new mortgage note that you buy isn't as good as the ones you're going to get today. It's 7.5%, 7.75%, right? So why would you buy something like that? So those lenders lending jumbos for the last 6 months have really been stuck with the loans because they can't get rid of it. Therefore, if you're going to do a loan, a jumbo, with these people, you're going to have to pay through the nose. Well, we still see that happening, although not as much as it was. I guess there is some loosening, some selling off, some way by which those particular loans at 3% jumbo can be monetized in order to replenish the mortgage pool that particular lender is using. But 7.32%. Now, the 5/1 ARM, which was traditionally a very attractive rate because it's a shorter-term loan, it goes into a adjustable rate mortgage after that. Well, today is the 6.58. It's one of the lower-priced loans out there in the marketplace, and it's a pretty good loan. Look, if you're going to be in your place, you're a business person, you've moved to a particular area, you're only going to be there for a short time, you want to invest in real estate rather than spend it on rent. I get it. Some people think that's a better way to go in terms of both their investment, their lifestyle, and how they want to spend their money. This 6.58% is actually one of the lower conforming loans out there among the several I've mentioned. So it's not such a bad idea, and it's quite a divergent look at what we were even for 3 months ago, where we saw that the 30-year jumbo 30-year and the 5/1 ARM were very similar in terms of their rates. The 2-year is at 5.02%, so the 2-year is still above 5%. That's a pretty good deal. I mean, if you're out there looking for an investment and you're thinking about, well, maybe I'll get into real estate. I'll buy a house and rent it out. Well, have you got a cap of 5%? Because that's what you're going to get from a 2-year treasury. Maybe time to reconsider, go into treasuries and wait 2 years till the prices of the houses come down. Maybe the mortgage rates come down. That's a possibility and a pretty good one. I like it, actually. The 10-year is at 4.276%. The 10-year has really retreated quite a bit. We had a closing of the gap. Now, this inverted yield curve, which is supposed to predict a recession, which never really happened, is kind of gone out of style in terms of people talking about it. But there is quite a spread here, almost 80 basis points between the 2-year and the 10-year, and that spread being what it is. Yeah, it's just interesting if you're looking at long-term way by which you can invest your money. Real estate is certainly a way to go. The 2 or the 10, I'd go the 2 myself, but that's the way it is. The mortgage demand overall has dropped this year, dropped this month, dropped this week. The mortgage demand dropped on the refi level year over year 31%. That's huge, right? We were already down from last year because the rates went up. Now we're really down. The mortgage demand for purchases dropped 27%. So on average, 30% for all mortgages, purchase and refi. The demand for those products have dropped 30% is a big deal. And it's really not seen since 1996. Now, I bought my house that I still live in 1995. And I think we paid 8.75% on that. Happy to get it, right? Borrowed the money for the down payment, could make the monthly. So if you're in that same boat, I feel you. I feel the pain. Nobody wants to do 7.5%. But at the same time, where's it going to be in 6 months? As I said earlier segment, I think by the end of the year we might see 8%. And that's something that nobody wants to see. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Appreciate you listening to the show, and we will be right back.